Hi, my name is Vashi and I like to talk about finances, well-being and being single. This is part 6 in my 10-part investing series, and if you haven't already checked out parts 1 to 5, I will link them down below. Please do check them out. Can I just say thank you to everyone who watches my videos and anyone who's recently subscribed. I really appreciate that you take the time out to watch my videos, and it really means a lot. I do want to find a way to connect with you all, so leave a comment down below or connect with me on my Instagram. It's a page where I draw comics, but I do often show myself and I'm super active on there and would love to engage with you all, so yeah, comment down below or check me out on my Instagram. Thank you. In this video, I'm going to talk about what investing in bonds actually means. So, what is a bond? Bonds are basically a loan that an investor, so for example, you or me, will provide to a borrower, typically a corporate or a government. In return, the investor will get interest on that loan, and after a set period of time, we'll get the interest and the principal, which is the initial amount that we lent, we'll get all of that back in full. Bonds are called fixed income instruments because traditionally they paid investors fixed amounts of interest. Both governments and corporate institutions will use bonds to borrow money, for example, if they need extra funding to build a road or schools or fund a new research and development project. Bonds are essentially a legal and binding contract, and this means as long as they don't go bankrupt, the entity that you loan to are by law required to pay you back. And for this reason, bonds are considered to be a much safer investment than investing in things like stocks, because investing in those, there's no real guarantee that you'll get any kind of investment back. However, there is a drawback to investing in bonds, and this is, for example, if you're investing in bonds in a company, if the company does happen to do well, the shareholders will benefit a lot more than bondholders because, like we've covered, the bondholders receive a set amount of interest and only the principal that they put in, whereas the shareholders benefit from an increase in the share price and get a chunk of that company's profits too. And as you might have already guessed, because of this, bonds offer a lower return than investing in things like stocks and shares on average, and therefore if you're looking to grow your money over time, stocks and shares are probably a better investment. However, if the market is super volatile and you don't really know where to put your money, then investing in bonds might be the safest thing you can do at that point in time. As we've covered before, you want your investment portfolio to be as diverse as possible. So if you're looking to achieve this, it might be a good idea to invest in a few bonds, which might give you a better rate than, for example, a savings account, but with lower risk than investing in stocks, for example. So how do you invest in bonds? So to invest in bonds, you will need a brokerage account, which we've covered in a bit more detail in part 3. And like with stocks, you can also invest in individual bonds or you can invest in bond funds. And the advantages of investing in separate bonds versus funds is pretty much the same as for stocks and funds. So I cover this in part 4, so check that video out if you're curious. But like I've said time and time again, investing in funds, you're diversifying your investment and therefore it's lower risk than picking individual bonds. There are 2 main things that you must look out for when you're investing in bonds, and the first one is credit quality or credit worthiness. Credit worthiness is basically a measure of how likely you are to get your money back and how strongly that entity, that company, that government is likely to meet its financial commitments. Yes, with bonds, you are legally required to get your money back. However, if that institution or that government becomes bankrupt, that may not be the case. Credit worthiness is determined by a credit rating, and the common measure of this is the Standard & Poor's credit rating scale. And this ranges from AAA, which is the best of the best, all the way down to D, which is basically trash. Any institution that has a credit rating of BBB and above is considered to be investment grade, and anything below BBB is considered to be a junk bond or super risky and not worth investing in. And like we've covered before, with any investment, higher risk generally means a higher reward, and therefore you'll find that firms which have a lower credit rating will often offer the highest interest rates. The second thing you need to look out for when investing in bonds is the yield. A yield is a percentage that indicates how much money you're making on your investment. For example, the current rate of a 10-year UK government bond, which has a credit rating of AA, is around 0.7%. This means that for a £100 investment, you will get about 70p of interest. Some government bonds in other countries offer staggeringly high interest rates, so I've seen between 20 and 40%. But like I've just covered, if you look at their credit rating, it's basically trash. So even though there's a super high yield, there's a high chance that you're not going to get your money back in the first place. With bonds, there's definitely a trade-off between yield and creditworthiness, so it's definitely something to consider if you are investing in bonds, and also what your risk tolerance is. So that's a super high level overview of what bonds are, and I hope you found that useful if you are considering investing in some. My next video, part 7, will be a brief overview on how you might begin to do some research and fundamental analysis when you're looking at beginning to invest in companies. That video will be out in a few days' time. If you're here early, you may have to wait a little bit for that video to come out. However, if you're here a little bit later, please skip on to the next video and I will see you there. Okay? Bye!